In this video, part 3 of my 4-part series on the wheel strategy, I've got a real decision to make. I have both a cash secured put and a covered call expiring today, and they're both close to the money. So I walk you through the process of deciding whether to roll them straight out to the same strikes or adjust the strikes, rolling the put down and the call up. I compare the net credit for each option, show you exactly what I'm offered on Thinkorswim, and explain how I weigh the trade-off between earning more premium right now versus increasing my protection from assignment or positioning for more capital gains on the call. At the end, I also show you the total income and cost basis for my 200 share position and walk through how I calculate my break even. In this example, I have 200 shares of NVIDIA and a cash secured put with a strike price of $135 expiring today and a covered call with a strike price of $135 expiring today. The share price of NVIDIA has been fluctuating during the day between $133 and a little more than $135, and I don't know where it's going to land at the end of the trading day. So either one of these contracts is at risk of assignment. And I've decided that rather than accept assignment, I would like to roll these positions for more income. I'm going to compare two different rolls for each contract. I can either roll them straight out, keeping the same $135 strike price, or I can try to roll the cash secured put down to a strike price of $130, and I can try to roll the covered call up to a strike price of $140. If I can roll the put down or the covered call up for a net credit, either one of those will improve my position. So let's start with the cash secured put. In order to roll this position out 14 days, I need to actually make two trades. I will need to pay to close the $135 put that's expiring today, and that's going to cost me about $185. And then I can sell a new put expiring on June 13th. If I keep the same strike price of $135, I can bring in about $500 for it. And if I roll it down to $130, I can bring in about $293. Thinkorswim will automatically fill out the order form for me and let me compare the net credits that I could get from each of these rolls. So I click the checkbox next to the $135 put that's expiring today, and I go down here and click Roll. The order screen that came up is for a straight roll, keeping the same strike price and rolling out 7 days. But I've already decided that I want to roll out 14 days, so I'm going to change the date on the new contract that I'll be selling. If I keep the same strike price of $135, I can generate $322 to $329, maybe $333 in options premium in my net credit. If I roll the contract down to a new strike price of $130, I will generate less income, but I will also pay less for the shares if they're assigned to me later. Rolling down to $130 a share, I can still generate $95, maybe $97. So my choice is about a $95 net credit for rolling down to $130, which is still a 19% annualized return, or a $325 credit by keeping the same strike price at $135. Now, this is a much more attractive rate of return, but by keeping this same strike price, I am rolling a position that is in the money, likely to be assigned, and for which I would pay more than the shares are currently worth. So I'm going to choose this roll. I'm going to roll down to $130 a share. The order filled at $1.06 per share. So after the trading fees, I will receive $104.68. That's a very respectable, almost 21% annualized return, and it rolls my position out of the money. Now let's take a look at the covered call. The $135 covered call will cost me about $33 to close, and I am willing to pay that because I am trying to avoid assignment on this position so that I can generate some more cash with it. And if I look over here at the probability in the money, there's still about a 1 in 4 chance that it would go in the money before the end of the trading day and these shares would be called away from me. So I'm going to roll out either to a strike price of 135, generating $375 in premium, or I will roll out to 140, generating $191. I'm inclined to roll up to the $140 strike because if the position goes back in the money, I would like to generate the additional $500 in capital gains. But let's compare the two rolls. I'm going to check the box next to the position that's expiring today. Go down here and click Roll Selected. The order form populated with a 1-week roll with the same strike price. I'm changing the date from June 6th to June 13th. If I keep the same strike price of $135, I can generate $344 to $346. If I change the June 13th strike price to $140, I can bring in between $161 and $162. I paid $132 a share for these shares, but right now they're trading at $133.90. So I'm going to use the higher number as my collateral value. Either one of these rolls generates a pretty solid annualized rate of return. And the $140 strike also gives me an additional $500 of potential capital gains. So I'm going to roll this position up to the $140 strike. It filled at $164 less some trading fees. My position is now set up with both the put and the call out of the money, and I can just continue to roll them and manage them in whatever way seems best when I arrive to June 13th. If I look back at the trade log, you can see that I've generated more than $200 in options premium on the puts and close to $300 on the calls, and the shares are worth more than I paid for them. So I'm profiting multiple ways here. I have sold a put, rolled a put, bought 200 shares, sold a call, and rolled the call. Right now, my total out-of-pocket expense is $25,901, and I have 200 shares. My average investment per share is just under $130 a share, and the shares are currently worth $133.90. That's how I think through a real-time rolling decision with both a put and a call expiring close to the money. If you're following this as part of my 4-part wheel series, the next video will walk you through how I manage the full strategy with flexibility, sometimes trading both sides at once, reinvesting dividends, and using what I call the Patricia special.